Welcome, curious minds, to another deep dive. We often hear about job numbers tossed around in the news, right?
hmm
But have you ever really stopped to think how a seemingly small shift in those figures can send, well, shockwaves through Wall Street?
Absolutely. And not just Wall Street. It can completely reshape what the Federal Reserve might do next.
And even surprisingly, ignite some pretty intense political drama. It sounds a bit counterintuitive, maybe.
It can seem that way, but it's true. The economy is this complex web.
That's right.
Sometimes what looks like a minor blip is actually the first sign of bigger shifts happening under the surface.
Like about reading those subtle signals.
Exactly. Understanding the context.
And that is precisely what we're going to unpack for you today. Our focus is the recently released July 2025 jobs report for the U.S. economy.
Yeah, these reports can feel like just a jumble of numbers sometimes, very dense.
Right. So our mission today is simple. Make it easy for you to grasp what really happened, what it means for markets, for the Fed, and, yeah, touch on that surprising political fallout, too.
We want to give you that clear picture, kind of the key takeaways without getting lost in the weeds.
Exactly. No information overload.
Yeah.
And just so you know, for this deep dive, we've pulled insights from a whole range of sources.
We looked at major news outlets like AP News, Reuters, but also more specialized places like Bloomberg and MarketWatch.
Just to make sure we're getting a really comprehensive,
hmm
balanced view for you, connecting all those dots.
Okay, so where do we start? The big picture.
Let's dive in. Looking at this July report, the headline figures, the ones that immediately, grabbed everyone's attention, they absolutely screamed, slow down.
They really did. It felt like the U.S. economy kind of slammed on the hiring brakes in July.
So the key number everyone watches is non-farm payrolls. Can you give us the simple version of what that means?
Sure. Basically, it's the total number of paid employees in the U.S., but it excludes farm workers, people working in private homes, and some government folks. It's like the main measure of job creation.
Got it. And in July 2025, how many jobs were added?
Only 73,000.
Wow, only 73,000. And just to put that into perspective for you, what were people expecting?
Well, the forecasts were clustered around 110,000 to maybe 115,000 jobs. So 73K was way off.
Yeah, a huge miss. We're talking almost half of what was expected. But honestly, that wasn't even the most shocking part, was it?
No, not at all. The real story, the part that made everyone sit up and take notice, was in the revisions to previous months.
Ah, the revisions. This is where it gets interesting and sometimes a bit concerning. Explain how that works.
Right. So the Bureau of Labor Statistics, the BLS, they collect this data, but it takes time for all the information to come in. So they often go back and adjust the numbers for the previous couple of months as they get more complete data.
Okay, so what did they adjust this time?
Well, the adjustments were, frankly, staggering.
Yeah.
May's job growth, which initially looked okay, was revised down to just 19,000 jobs.
19,000. From what originally?
It was significantly higher before. I don't have the exact original number handy, but it was a major cut. And June was slashed down to only 14,000 jobs added.
14,000. I mean, that's barely moving the needle. So if you combine those revisions...
That's the kicker. You combine those downward revisions for May and June, and suddenly you've cut a massive 258,000 jobs from the numbers we thought were accurate just a month or two ago.
Wow. 258,000 jobs just vanished from the record. That's a huge aha moment, isn't it?
It really is. It completely changes the narrative.
Yeah, it tells us this slowdown isn't just some random blip in July. It's like finding out that slight cough the economy had. It was actually persistent fever that's been brewing for months.
Exactly. It suggests a much more a persistent deceleration than we initially realized. We're only now seeing the true picture, and it's, starker.
And tied into that, what happened with the unemployment rate?
It ticked up slightly, went from 4.1% in June to 4.2% in July.
Okay, 4.2%. Historically, that's still pretty low, right?
It is, relatively speaking, but the direction matters. A rising unemployment rate, even a small rise, usually indicates the labor market is loosening up a bit.
Meaning more people looking for work compared to the jobs available.
Precisely. It's generally a sign the economy is cooling down, maybe slowing more significantly than we thought.
And what about wages? Did they show anything dramatic?
Not really. They were pretty much in line with expectations and recent inflation trends. Average hourly earnings were up 0.3% for the month, which is 3.9% over the year. Important, always, but not the big shocker this time.
So the real story was the lack of new jobs and those enormous revisions looking back.
Definitely. That painted the picture of a cooling economy.
So if overall hiring slowed down so much, and we now know it's been weaker for months, were there any areas still adding jobs, or was it weak across the board?
Good question. Even in a slowdown, you usually see some pockets of strength.
And we did see that here.
We did. The main bright spot, perhaps unsurprisingly, was healthcare and social assistance. That sector really led the way.
How many jobs did they add?
Healthcare services added about 55,000 jobs, and social assistance added another 18,000.
Okay, so pretty strong numbers there. Why do you think those sectors hold up better?
Well, demand for healthcare and, social support tends to be pretty consistent, regardless of the broader economic cycle. People still get sick, need care, need assistance. It's more resilient.
Makes sense.
Hmm.
Okay, so that was the main winner. What about the losers? Where did we see job losses?
There were a couple of notable ones. Manufacturing actually shed 11,000 jobs.
Manufacturing is often seen as a bit of a bellwether, right?
It can be, yeah. It often reacts pretty quickly to shifts in consumer demand, trade issues, business confidence. So losses there can sometimes signal broader weakness.
Okay, anywhere else?
Federal government payrolls also fell by about 12,000 jobs, but that was apparently due to an ongoing federal hiring freeze, so maybe less about the economy and more about specific policy.
Right, just not replacing people who leave.
Exactly.
And what about other major sectors like construction, retail, professional services?
Mostly stagnant.
Yeah.
Very little change, up or down. Mining, construction, retail, professional, and business services, they were all pretty flat.
So that kind of reinforces the overall picture, doesn't it? A broad slowdown across many different areas, not just one or two specific problems.
Yeah, it points to a real lack of hiring momentum across the board.
Okay, so we have these numbers, low growth, big revisions, some sectors up, some down, many flat.
Yeah.
Now, what's really fascinating is how this stuff, these statistics, ripple outwards, right?
Oh, absolutely. The impact on financial markets and, crucially, on the Federal Reserve's thinking is immediate and often dramatic. This is where the numbers hit the wider economy and potentially, your wallet.
Let's talk markets first. What was the immediate reaction on Wall Street when this report dropped?
Not good. Major stock indexes slumped pretty significantly right after the release.
Like how much?
Well, the S&P 500, which is a good broad market gauge, fell 1.6%. The Dow Jones was down 1.2%. And the Nasdaq, which is heavy on tech stocks, dropped 2.2%.
So a definite thumbs down from investors.
Yes, and it's worth noting this also happened around the same time as news about fresh executive tariffs, basically new taxes on imports.
So that probably added to the uncertainty and unease for businesses and investors.
Likely compounded things, yeah. Businesses were already looking at weak job growth, and then you add trade uncertainty on top. It makes for a nervous market.
Okay, but maybe the biggest ripple effect was on the Federal Reserve's outlook, right?
It's definitely the most significant policy implication. We need to talk about rate cuts here.
Right. So for anyone listening, can you quickly explain what a rate cut is and why the Fed does it?
Sure. The Fed sets a benchmark interest rate. A rate cut is when they lower that rate. The goal is usually to stimulate the economy.
How does lowering rates help?
It makes borrowing money cheaper for consumers buying homes or cars, for businesses wanting to invest or expand. Cheaper borrowing encourages spending and investment, which hopefully boosts economic activity and job growth.
Got it. So how did this jobs report affect the chances of the Fed cutting rates?
Dramatically. Before this report came out, the financial markets were pricing in about a 38% chance of the Fed cutting rates at their September meeting.
Okay, so less than a 50-50 chance.
Yeah.
More unlikely than likely.
Right. But after this jobs report, with the weak hiring and those huge downward revisions, the probability jumped significantly.
How high did it jump?
Depending on the specific market measure you looked at, it shot up to somewhere between 80 and 88%.
Wow. From 38% to over 80%. That's an incredible shift in expectations based on one report.
It really is. It shows just how much weight the market puts on these numbers, especially when they signal a potential slowdown.
So what does that shift tell us about how the market sees the Fed's likely reaction?
It reflects what economists call growing expectations for dovish policy.
Okay, dovish. What does that mean in Fed speak?
Dovish basically means the Fed is leaning towards policies that support economic growth, often by lowering interest rates. It's the opposite of being hawkish, which means they're more focused on fighting inflation, usually by raising rates to cool things down.
So weaker job numbers made the market think the Fed would turn dovish and cut rates to help the economy.
Exactly. It's that classic, slightly paradoxical thing where bad news for the economy, like weak job growth, can actually be seen as good news by investors hoping for lower interest rates.
Because lower rates can boost stock prices and make borrowing cheaper for everyone.
Precisely. It impacts mortgages, car loans, business investment, pretty much everything related to borrowing money.
So you can really see the direct line from that jobs report to potential changes in your own financial life. It's not just abstract numbers.
Not at all. But beyond the markets and the Fed, there was another layer to this story, wasn't there? Some commentary and even controversy.
Yes, this is where things took a, let's say, surprising political turn. What happened shortly after the report came out?
Well, President Trump made a very significant move. He fired the commissioner of the Bureau of Labor Statistics, Erica McIntyre.
Fired the head of the agency that puts out the jobs report. Why?
He publicly accused her of mishandling data. The implication seemed to be that the poor numbers were somehow her fault due to errors or maybe even manipulation.
Okay, that's a serious accusation against the head of a statistical agency. What was the reaction to that?
Well, as our sources reported, critics immediately pushed back very strongly. They warned that firing the BLS commissioner like that seriously undermines trust in official statistics.
Why is that trust so important?
The argument is that agencies like the BLS need to be seen as independent and impartial, free from political pressure. If people start thinking the numbers are being politically manipulated, then the data loses its credibility. And we rely on that data for, well, everything from policy decisions to business planning.
Right. So just to be clear for our listeners, we're reporting these events and the different viewpoints, the accusation and the criticism exactly as presented in the sources without taking any sides ourselves. It's about showing you the full context.
Absolutely. And beyond those political headlines, analysts looking deeper into the report had their own interpretations, particularly about those huge revisions.
That negative 58,000 job adjustment we talked about.
Exactly. Some analysts saw those unusually large revisions as a sign of, quote, broader payback.
Broader payback. What does that mean?
They were suggesting that the slowdown wasn't just a random event, but maybe the delayed result of other economic pressures that have been building.
Like what kind of pressures?
They pointed to things like ongoing trade uncertainty, unpredictable tariffs making businesses nervous about investing, also immigration crackdowns, which could be limiting the supply of available workers in some sectors, and just general business hesitation, a reluctance to hire or expand when the economic future feels unclear.
So the idea is that these bigger, maybe slower moving factors are now finally showing up directly in the job numbers, like a delayed reaction.
That seems to be the interpretation, yes. That the weak numbers, especially the revisions, reflect these underlying economic headwinds finally taking a toll on hiring. It highlights how interconnected everything is: policy, business confidence, and ultimately jobs.
Okay, so we've covered a lot of ground here. Let's try to consolidate this for everyone. What's the bottom line? What are the key takeaways from this July 2025 jobs report?
I think the main message is a sharp cooling in U.S. hiring. It was weak in July itself.
Right, and crucially, those huge downward revisions for May and June suggest this isn't just a one-month blip. It points to a more persistent slowdown that's been happening for a while.
Exactly. And while the unemployment rate, 4.2% is still moderate, the fact that the slowdown was pretty broad across sectors highlights this feeling of rising economic uncertainty.
It's not panic stations yet, definitely not a recession call based on this report alone, but it's a clear warning signal, wouldn't you say?
Undeniably, the labor market is clearly losing steam compared to before.
So what, for people listening, what are the most direct impacts?
Well, two big things jump out. First, as we discussed, it has absolutely reignited expectations of a Federal Reserve rate cut in September. That's huge for markets and potentially for borrowing costs.
Cheaper money might be on the way?
Could be. And second, unfortunately, it has triggered political turmoil over the credibility of labor data. That raises serious questions about trust and the very information we use to understand our economy.
So as you think about what this all means for your own outlook, your finances, maybe your job security, future plans, it's worth remembering these reports are more than just numbers.
They really are. They're indicators of these bigger economic currents that affect all of us.
Absolutely. And maybe that leads us to a final thought to leave you with as we wrap up this deep dive.
All right.
Given the volatility we saw in this report, especially those revisions and the political reactions we just talked about, how important is it for all of us to really critically evaluate the sources of economic data we rely on?
That's a really crucial question. And maybe adding to that, How might this kind of persistent economic uncertainty, even if unemployment stays relatively moderate for a while, shape our own decisions going forward? About careers, savings, investments.
Lots to think about there. It's certainly a situation worth keeping a very close eye on in the coming months.
For sure. These numbers tell a story, and it feels like the next chapter could be quite important.
Well, thank you for joining us on this deep dive into the July jobs report. Keep that curiosity burning, stay informed, and we'll catch you on the next one.